Okay, so picture this, you're just chilling, enjoying your morning coffee, and suddenly, bam, a dividend check lands in your lap every single month, like clockwork. That's the reality. For folks who've invested in Realty Income or Agree Realty, and today we're going to take a deep dive into these two REIT giants who just love those super reliable net lease properties.
Yeah, those net lease properties are really interesting. You know, those retail spaces where the tenants, they handle most of the operating costs.
Right, exactly. Predictable income for the REIT, which of course means those nice monthly dividends you were talking about. So to help us navigate this world, we've got this Motley Fool article. And it's a head-to-head comparison of Realty Income and Agree Realty.
Yeah, and they're both big players in the REIT game.
Absolutely. But their strategies and financials, they've got some interesting differences. That could make one a better fit for you than the other. Now, we should say up front, the Motley Fool author, they've got a clear favorite.
Yeah, they do.
But our goal today is to give you all the info so you can decide for yourself.
That's right. This deep dive isn't just about picking between these two REITs. It's about giving you the tools to evaluate similar investment opportunities later on down the road.
I like that. So let's introduce our contenders, shall we? Realty Income, ticker symbol O, which is kind of fitting, right?
Makes sense.
They're the heavyweight here. Over 15,000 properties spanning the U.S. and Europe. And get this, they're spread across 90 different industries.
Wow, 90 industries. That's impressive. Now, you might be thinking, why should I care about that?
Right.
Well, imagine there's like a downturn in, say, the restaurant sector, right?
Okay.
If Realty Income was only focused on restaurants, their income would tank, But with all that diversification, less vulnerable to shocks in any one industry, a little more peace of mind for investors.
Makes sense. Now, Agree Realty, ticker symbol ADC, might be smaller. They've got 2,200 properties, all in the U.S., but they've got their own kind of secret weapon.
Oh, yeah. What's that?
Ground leases.
Ground leases, huh?
Owning the land itself. The tenant, they handle everything built on top of it. It's even more stable than a traditional net lease.
Oh, I see. You're right. Those ground leases are known for their long terms. Sometimes, stretching up to 99 years.
Wow.
That means super predictable cash flow for Agree Realty, but maybe less opportunity for rent increases over time.
Interesting. Okay, let's get into the numbers. The article throws out some interesting stats. The one that really jumps out is dividend yield. Realty Income boasts a very tempting 5.5%. Agree Realty, a respectable but lower 3.9%. Now, for someone who wants immediate income, that difference, it's significant.
Yeah, it is. Tells us right away that the market values these two REITs differently. But here's what's interesting. Despite that yield gap, Realty Income and Agree Realty, they have almost the exact same dividend payout ratios, meaning they pay out roughly the same proportion of their earnings as dividends. So why the difference?
The article points to Realty Income having a lower valuation compared to Agree Realty, which is a little puzzling. Yeah. Especially since Realty Income has a slightly higher projected growth rate. For this year, how do you make sense of that?
It's a good question. And to answer it, we need to go a little deeper into this concept of leverage.
Okay.
Now, at first glance, Agree Realty seems less leveraged, meaning they're using less borrowed money to finance their operations.
Right.
But when you factor in their unsettled forward equity, basically a promise to sell shares in the future, it gets a little more complex.
It's kind of like a hidden form of borrowing.
Exactly.
Could you maybe break down how that unsettled forward equity impacts an investor's analysis?
Sure. So this unsettled forward equity, think of it as a promise Agree Realty's made to sell shares at a future date, like a hidden loan. Get cash now, pay it back later by issuing those shares.
Okay.
And this can dilute your ownership over time. Your slice of the pie gets smaller. Definitely something to consider.
Right. Now, another thing that stood out to me was creditworthiness. The article mentions Realty Income has a higher credit rating than Agree Realty, an A compared to a BBB plus face. What's the significance of that for an investor?
Well, creditworthiness, it's super important, especially for long-term investors in REITs. It means the company can meet its financial obligations, including, of course, those dividend payments, even when the economy's, not doing so great.
That's reassuring. And I imagine a higher rating, like Realty Incomes, also means lower borrowing costs.
Exactly.
Which could be a big advantage for future growth.
Right. That's something the article doesn't explicitly say, but savvy investors should consider it. Access to cheaper capital can be huge in a market like real estate.
Right. So now that we've got the financials, let's peek inside these REITs portfolios. Realty Income, with their massive 15,000 plus properties. Goes beyond just retail, right? I read they even have gaming properties and data centers.
That's right. They've got industrial real estate, gaming properties, even data centers, exposure to all sorts of sectors. And about 32% of their rent comes from investment-grade tenants.
Okay.
So another layer of stability.
So they really seem to have all their bases covered. Now, how does Agree Realty's portfolio compare? They're much more focused, right?
They are mostly retail properties,
Huh?
but with a big emphasis on those ground leases we talked about.
Right.
Almost 11% of their annual rent comes from those ground leases. And actually, they have a higher concentration of investment-grade tenants than Realty Income.
Oh, really?
Yep, 67.5% of their rent from those reliable payers.
Interesting. So even though Agree Realty's is smaller and more concentrated, they still prioritize quality and stability just as much as Realty Income.
Absolutely. It all comes down to that classic risk-reward trade-off in investing Realty Income. With their wider net, more opportunities for growth.
Right.
Across different sectors and markets, but they're also exposed to more risks.
Right. And Agree Realty, with their laser focus, they might experience smoother sailing during economic storms, but they might miss out on those high growth opportunities.
Exactly. It all comes back to you, the listener. Your goals and risk tolerance. There's no one right answer.
So we've got Realty Income, the giant diversified approach with that tempting 5.5% yield, and then Agree Realty, more focus on stability, 3.9% yield.
Yeah.
Before we get to the Motley Fool's verdict, what are some key takeaways so far?
I think the big one is that Realty Income and Agree Realty offer different advantages and disadvantages. Realty Income's size and diversification provide a certain level of resilience and potential for growth. And their dividend yield is attractive. On the other hand, Agree Realty's emphasis on ground leases and investment-grade tenants offers a more predictable income stream, albeit with a lower current yield. Understanding those differences is crucial.
Very nicely put. So with all that in mind, let's see what the Motley Fool has to say.
Well, the Motley Fool author, they definitely lean towards Realty Income, and it's all about that higher yield and lower valuation combo. Makes sense if you're after immediate income and potential for price appreciation.
Yeah, especially with their size and track record. But I'm wondering, are there any situations where Agree Realty might actually be the better choice? Maybe for a specific kind of investor.
You're right. Not every investment is perfect for everyone. The Motley Fool makes a good case for Realty Income. But there are definitely times when Agree Realty could be a better fit.
Like what kind of situations are we talking about?
Well, think about investors who really prioritize stability and predictability above everything else. Someone nearing retirement, maybe? Or someone with, a lower risk tolerance.
Right.
Agree Realty's focus on those rock-solid ground leases and their investment-grade tenants could be really appealing.
I see what you mean. That steady income stream could be way more valuable to them than the potential for higher growth with Realty Income. And don't forget, Agree Realty actually has a higher concentration of those investment-grade tenants.
That's right. So even though their overall yield is lower, that focus on quality tenants could mean more consistent dividend payments over the long run, which is a big plus for risk-averse investors.
Yeah, I'm starting to see how this decision really depends on your individual priorities and what you're hoping to get out of your investments.
Exactly. If you're someone who enjoys a little more excitement and you're comfortable with some ups and downs, Realty Income might be appealing. But if you prefer a steady, predictable path, Realty could be more your style.
So for our listener, who's trying to figure out which approach is better for them? What questions should they be asking themselves?
Well, it starts with some honest self-reflection. What are your main financial goals? Retirement, future expenses, something else entirely?
And how much risk are you really comfortable with? It's easy to think we can handle those market dips, but when they actually happen, it can be pretty stressful.
You're right. It's also important to think about your timeline. Investing for the long haul. Or do you need access to your money soon?
All good points. We also need to think about the overall economic landscape and how it might affect the real estate market. We're recording this in late 2024.
Yeah.
And there's a lot going on that could influence how REITs perform.
Absolutely. The real estate market, it's always changing. And external factors always come into play, like interest rates, for instance. The article talks about current valuations. But what about future interest rate hikes? How might those affect these two REITs?
That's a great point. Higher rates could make borrowing more expensive for REITs, which could definitely affect their growth plans. But Realty Income, they have that higher credit rating. Could that give them an advantage when it comes to getting loans with better terms even if rates go up.
That's a really good observation. Their creditworthiness could definitely be a big help. But we also have to consider that rising rates can affect property values, could lead to slower growth, or even declines in some parts of the market.
So we've got these external forces at play. And it seems like rising rates could be both good and bad, depending on how things go. Anything else our listeners should keep in mind when trying to figure out how these companies might perform?
Well, you also want to consider the broader economic outlook. If the economy weakens, consumer spending could go down, which would impact retail sales, and that could hurt retail REITs.
Right. And even within retail, there are all these different trends, like the rise of e-commerce. It's really changing things. Some traditional stores are struggling, others are adapting. How do these two REITs portfolios position them for all this change?
Another great question. It really shows why it's important to look closely at those portfolios.
Yeah.
Realty Income, with their diverse holdings, they do have some properties that might be more vulnerable to e-commerce, but they're also involved in other sectors, like industrial real estate and data centers. That could help offset those challenges.
Those sectors do seem well positioned to benefit from e-commerce and online services in general. What about Agree Realty?
Their focus on essential retail, like grocery stores and drugstores,
Yeah.
could provide some resilience.
Right. People still need to buy those things, no matter what's happening online. And let's not forget those ground leases.
Exactly.
Even if a tenant struggles, Agree. Realty still owns that land.
That's a key point. Those ground leases, they provide a lot of stability for Agree Realty.
So we've gone beyond just the numbers here. We've talked about interest rate changes, the overall economic outlook, and how these REITs are positioned for the future retail. I think our listener has a lot to think about now.
I agree. It's all about going deeper, looking at the nuances of an investment. The Motley Fool article is a great start, but you got to do your own research and think about everything.
Absolutely. With all that in mind, I think it's time to offer our listener some final thoughts and takeaways. So we've covered a lot of ground today, those financial metrics, the ins and outs of each REIT's portfolio, and how all this might be affected by, well, the economy. As we wrap up, what are some key takeaways you hope our listener walks away with?
Well, I think the biggest one is that there's no magic formula when it comes to investing. What works for one person might be totally wrong for someone else. It's all about your goals, your risk tolerance, and how long you plan to invest.
Right. We've also seen that it's so important to go beyond the headlines, dig into the details. The Motley Fool article was a good starting point. But, like we said, there's always more to the story. Asking those tough questions, considering different viewpoints, doing your own research, it's all crucial.
Absolutely. And don't be afraid to, challenge those assumptions. The market's always changing. What looks like a safe bet today might not be so safe tomorrow. You got to stay informed and be ready to adapt.
Okay, so for our listener, who's now got all this info, what's the next step?
I'd say take some time to think about what we've talked about, your own goals, how comfortable you are with risk, and how these two REITs, Realty Income and Realty, fit into your overall plan.
And no need to rush into a decision. Investing, it's a marathon, not a sprint. Take your time, do your research, read that Motley Fool article, weigh the pros and cons.
And remember, there are resources out there to help you. Financial advisors, online forums, even just websites with educational content. They can all provide valuable insights.
So true. A ton of information out there. Just got to tap into it.
And hey, maybe this deep dive has sparked a new interest in real estate investing. It's a really interesting sector. Lots of potential there.
Well said. On that note, I think it's time to wrap up our deep dive into Realty Income and Agree Realty. Hope you found it informative.
We did our best. Keep learning, keep exploring, and most importantly, happy investing, everyone.